On paper, NIO looks like a company that has finally cracked the code. They just reported record-breaking monthly deliveries in June, shipping over 40,000 units in a single month. By almost every traditional growth metric, this should be the moment the stock takes flight. And yet, if you pull up the price chart, you see a completely different story. This is a stock that's essentially being left for dead by the broader market. So here's the burning question we're answering today. What is the hidden reason NIO keeps falling, even while it's selling more cars than ever before? And more importantly, what happens next? Is this a generational value play hiding in plain sight, or a value trap that's about to get much, much deeper? If you're the kind of investor who wants the real story behind the headlines, do me one quick favor and hit that like and subscribe button. It genuinely helps this channel grow, and it makes sure you don't miss the next breakdown. All right, let's get into it. That record-breaking delivery number sounds like a definitive win until you look at the fine print of the market's reaction. Because what we have here is a classic case of divergent realities. While the operations team is celebrating a 62.9% year-over-year jump in June deliveries, the stock has been slammed with a wave of persistent market skepticism. Why on earth would that happen? Because despite all those records, the company actually missed its own second quarter guidance by 2.1%. And in the ruthless world of high-growth tech and electric vehicles, a miss is a miss, no matter how many records you shattered along the way. Investors today aren't just hunting for growth anymore. They're demanding precision. And that single word, precision, is at the heart of everything NIO is struggling with right now. That lack of precision is reflecting painfully in the year-to-date performance. As of July 10th, NIO is sitting at just $4.78. To put that into perspective, we're currently trading about 40% below the 52-week high of $8.02. For anyone who bought into the hype last year, the pain has been very, very real. We've watched a 6% decline just since the start of this year, and that opens up a massive curiosity gap that we simply have to close. How can a company be selling more cars than at any point in its entire history, yet be worth significantly less than it was just 12 months ago? It almost defies logic, doesn't it? To answer that, we have to weigh the forces trying to launch this stock into orbit against the ones dragging it back down to earth. Let's start with the optimists. The bulls will point straight to the ES9 flagship SUV as the ultimate proof of concept. This vehicle didn't just launch, it absolutely dominated, crossing 10,000 deliveries within its first 30 days on the market. But here's the part that should really grab your attention. It's what analysts call the premium ASP lift. NIO isn't just moving units off the lot, they're moving high-margin units, with the average transaction price climbing to over $65,000 per vehicle. Now combine that with a research and development moat that includes over 9,000 battery swap stations spread across the map, and suddenly you're looking at a company that appears to be quietly building a multi-decade infrastructure empire. Sounds unstoppable, right? That sounds like a powerhouse fundamental story. But before you get too bullish and bet the farm, there's a much darker layer to this picture. Because the market isn't simply ignoring the good news. It's weighing the risks far more heavily than the rewards. Beyond that second quarter guidance miss, there's a looming sell the news sentiment hanging over the entire stock. Investors are genuinely worried that once the local purchase tax subsidies phase out, all of this beautiful demand we're seeing might just evaporate into thin air overnight. And then, on top of all that, you have the external political headwinds. The Pentagon designated NIO as a Chinese military company, a claim that NIO firmly denies, but one that nonetheless slaps a stubborn geopolitical discount onto the share price that is incredibly hard to shake off. So the fear is real, and it's baked into the price. However, if you can just look past the scary headlines for a moment, the raw valuation numbers tell a story that might genuinely shock you. NIO is currently trading at a price-to-sales ratio of just 0.8 times. Let that sink in for a second. Their industry peers are trading at an average of 2 times. Even NIO's own conservative fair value estimate sits comfortably at 1.2 times. What does this imply? It points to a massive undervaluation gap. Think about it this way. If NIO can simply stabilize its profitability and eventually trade in line with its own fair value, we could be looking at a significant upside move driven by multiple expansion alone, before you even factor in growth. So is the market just wrong about this one? Well, hold on. Here's where the story starts to get genuinely complicated. A low valuation like this usually exists for a very specific reason, and it's rarely a gift. The reason in this case lives on the balance sheet. In the fourth quarter of 2025, NIO achieved something truly historic. Its first ever quarterly GAAP net profit of $40.4 million, with vehicle margins hitting a healthy 18.1%. That was the exact signal so many long-term believers had been desperately waiting for. But that signal was immediately muffled, almost drowned out by the full full year 2025 results. We're talking about a staggering $2.14 billion net loss. And with a debt-to-equity ratio sitting at 1.94, this is a highly leveraged company that absolutely demands sustained delivery growth just to keep the lights on. There's very little room for error here. And it's not just the bank's money we need to worry about. We need to look closely at what the insiders and the so-called smart money are actually doing with their own capital. Institutional ownership currently stands at a respectable 48.55%, but the trend underneath the surface is decidedly mixed. While D.E. Shaw actually added to their position, showing some conviction, giants like UBS and Jane Street have been quietly trimming theirs. But the number that really catches my eye, the one that raises the hair on the back of my neck, is the founder stake. William Lee's ownership has drifted from 10% all the way down to 6.6% over the last few years. Now, founders sell for countless reasons, and it's not always a red flag. But seeing a decreasing stake during a period of record-breaking deliveries creates one deeply unresolved question for every long-term holder out there. Does the captain still have the same conviction in the ship as he once did? Or does he see something in the water that we don't? That lingering uncertainty is manifesting itself very clearly in the technical indicators. Technically speaking, the stock is stuck in what we call a bearish macro bias. We witnessed the death cross form back in June when the 50-day average slipped ominously below the 200-day average. Right now, we're trading nearly 15% below that 200-day moving average of $5.72. In plain, simple terms, the big money trend is still firmly pointed downward. And until we can decisively break out of that cycle, any rally we see is basically just a dead cat bounce in the eyes of most seasoned chartists. Not exactly the confidence booster the bulls were hoping for. However, if we zoom in a little closer on the shorter time frames, we actually start to see the very first signs of a potential floor forming. The MACD is finally crossed above its signal line, printing a positive histogram, which suggests that the intense, brutal selling pressure we saw earlier this year is finally starting to exhaust itself. Meanwhile, short interest is sitting at a moderate 5.46%. Now, that's not high enough to trigger one of those violent, explosive short squeezes like we see in meme stocks, but it does mean there's a meaningful pool of sideline capital that would be forced to buy back in if a genuine fundamental catalyst suddenly hits the wire. So the fuel is there. The question is whether anyone lights the match. And according to the options market, there is one very specific price level that will determine absolutely everything from here. The options chain reveals a massive call wall sitting at $5. There are over 18,000 contracts parked right there, acting like a heavy lid pressing down on the stock price. On the flip side, we have strong put support down at $4.50. This tells us exactly where the market believes the safe zone is. Traders are effectively hedging for a potential drop back toward those 52-week lows, but they are absolutely terrified, or perhaps secretly thrilled, about what could happen if we finally break above $5. That single level is the line between fear and euphoria. So the natural question becomes, how do we actually trade this thing over the next few days? For the window of July 11th through the 14th, the setup is clear, but demands serious discipline. We're looking for an entry somewhere between $4.85 and $4.95. The breakout threshold is that all-important $5 level. If we can manage to close above $5, we've got a clean, clear path to fill the recent gap up toward $5.30. But your line in the sand, your absolute deal breaker, is $4.72. If we break below that recent session low, the bullish thesis for this week is completely invalidated and you need to step aside. No exceptions. But if you're looking beyond just this week, the stakes get dramatically higher and the numbers get a whole lot more exciting. The consensus 12-month analyst target currently sits at $6.70, which already represents a significant return from where we are today. But the real story, the big payoff that keeps people talking about NIO in a life-changing context, is the 2030 base case of $12.06. Just imagine that for a second. But to actually get there, NIO has to nail two critical things. First, they have to sustain vehicle margins above 17%. And second, they have to prove they can genuinely monetize their world model software system, which already boasts 700,000 active users. If both of those pieces fall into place, this becomes a very different conversation. So which is it? Is NIO fundamentally uninvestable, or is it one of the most compelling growth stories on the market today? Let's weigh the final verdict honestly. The uninvestable thesis is painfully easy to see. A brutal competitive deep freeze happening right now in China, paired with a $2 billion annual cash burn that never seems to stop. But the compelling growth thesis is backed by real, tangible products like the ES9 and the brand new ES8, alongside that historic 18.1% margin achievement. This is without a doubt a high-risk, high-reward profile. It is absolutely not for the faint of heart. But for those who truly believe in the infrastructure NIO is quietly building, the current valuation offers a margin of safety that is rarely, if ever, seen in this sector. And that brings us to the one rule you need to follow for your next move. But before I give you my final verdict, I need to be completely transparent with you. Everything I've shared in this video is for informational and educational purposes only. I am not a financial advisor, and this is not financial advice. Investing in individual stocks, especially a volatile high-risk name like NIO, carries a real risk of losing your money. Please do your own thorough research and consult with a qualified professional before making any investment decisions. Your financial future is your responsibility. With that out of the way, here's my final take. Keep a very close eye on those July delivery orders and the upcoming second quarter earnings report, because those two events will tell you everything. If you're looking for a short-term trade, maintain a bullish bias only upon a confirmed close above that $5 psychological wall. Until that happens, NIO remains just a great car company searching for a stock price that finally reflects its reality. Tread carefully, keep your stop losses tight, and protect your capital above all else. Now, I'm genuinely curious what you think. Here's my question for you. If NIO is selling record numbers of cars, but the founder keeps selling his shares, would you trust the products or follow the insider? Drop your answer in the comments below. I read every single one. And if this breakdown gave you a clearer picture of what's really going on with NIO, smash that like button and subscribe so you never miss the next deep dive. I'll see you in the next one.